when you do see this ratcheting up of tariffs, when you do see all of the rhetoric, all of these big headlines, including today, that have been moving the markets by triple digits one way or the other, even if fundamentally not a whole lot has changed, what's an investor to do? How do you manage the risk?
Well, so I think the trade deal is critically important for the markets. Finding a path out where we don't make a bad situation worse is critically important. But I think what we should not forget is what happened on Friday from Chairman Powell. He effectively threw in the towel. That is, his comments on Friday were materially different.
What do you mean, threw in the towel?
Threw in the towel in that they will basically do a lot more things than just a mid-cycle adjustment that they were talking about after the July meeting. And I think the likelihood of them cutting rates in September or October is meaningfully higher as a result. If we reach stability with respect to the trade issues, not solving it, just stability, I think those two cuts and the underlying stabilization in the economy probably gets us higher.
Tobias, you love the industrials, or at least used to cover them for a long time. How should we be viewing them right now in light of what seems to be certainly softening in the global economy?
So it's partially the global economy, partially the domestic economy. Tightening up of financial conditions late last year, early this year, meant that 9 months later we're going to have a slowdown already. And that had nothing to do with the trade issues. That had to do with the really sharp sell-off in the fourth quarter last year. So businesses are already cutting some of their capital spending programs domestically. We did a study on this over 700 companies last week, published it, showing there has been some, not crazy weakening, but some modest weakening expectations. Not a surprise with confidence of the business community weak, earnings growth has been weak. Those are kind of associated. It doesn't help to have this kind of global issue not resolved, just kind of sitting there and weighing on people's mindsets. So I agree with Krishna. The one thing I'd be concerned about is if you look historically, when the Fed is in a rate cutting cycle, it is not good for equities. If you go back and look at Fed funds rates over time against the equity market, they're both coming down at the same time. So one shouldn't really be encouraging and getting excited about a long, kind of a long set of rate cutting.
Well, so that is indeed true. However, in an environment where consumption is really rock solid and incomes are growing and overall financial conditions ease meaningfully, I think that's probably good for the markets rather than bad for the markets. Normally, when they are cutting rates in a very aggressive way, we have kind of fallen off the cliff from a growth perspective. We haven't gotten there. We are still talking about 2% growth for 2019. And I think with rates as low as they are, that probably is good enough.